Andy, welcome to CFO at Home. Thanks for your time today.
Again, my pleasure.
One of the core tenets of your business, and this is what I pick up from scanning some of your material online, is that individual investors should break away from legacy fee models and understand the true cost of advisory services. So let's start there. I'm sure that a great many of our listeners today have a wide choice through 401ks, through IRAs, through certain investment vehicles. They have access to a wide variety of funds, stock funds, bond funds, and the reality is today we are looked at to manage those funds in a way to fund our own retirement. So how we manage those is very important. When we talk about fees, I've always had a little bugaboo personally about fees because you can get a financial advisor to talk to you about a lot of things and they're very open. I personally have found them reluctant to really get into a good discussion about fees. And if I am employing you to help me select investments or select investments, depending on how much I want to be involved, I at least want to know how much I'm paying for that service, not only what you're providing, but how much the fund is charging. There's a lot of fees nested in. So can you expand a little bit on what you call the legacy fee model?
Yes, sir. Yeah. So the industry basically started, the investment management industry really started with ERISA, the Employee Retirement Income Security Act of 1974. And I was in the business at that time. Okay. I've been around for a while. And so it started out and it started charging an asset based fee, 1% of assets a year. Okay. And it's 1% of the assets under management, or AUM. Okay. Now, as I've mentioned to you in the intro, before the intro here, is these fees are negotiable. That's by regulation. These fees have to be negotiable. That doesn't mean a manager is going to lower their fee necessarily, but the client should know that they are negotiable. So there are different levels of fees. These days, the investment vehicles, the ETFs, exchange traded funds, generally have very low fees. And the bigger providers or sponsors of these exchange traded funds charge very low fees. Some are even almost zero. I believe Fidelity has some that are almost zero. Vanguard's fees are like 0.03%. Okay. And fees matter. The one thing we can control for certain when we invest our money is the expenses that we pay to do so. Now, the good news is that in the last 20 years or so, it's been possible to invest ourselves with very low fees. And they're called expense ratios. A mutual fund is called an expense ratio, which takes into account just the management fee of the fund by the firm managing the fund, and also by the marketing fees and the administrative fees and so forth. That's called the expense ratio. And you can find that very easily if you just look at the fund prospectus or the summary of the fund. It'll tell you how much the fee is. But I wrote a whole book on this, Beat the Wealth Management Hustle. Okay. The industry is according to McKinsey, it's a $260 billion a year industry in 2024. These days it's probably $300 billion because the market's up. Okay. The market's up 20+% since then. All right, so $300 billion. Do they add value? So the question is, when you're talking to a wealth advisor or investment manager, how much do you charge, but what do I get for that fee? And do you make money from me after your fee relative to a market index? In other words, can I do the same return myself without paying any fee at all? And the answer is yes, you can. Okay, because it's really hard for anybody to outperform the index over time. And that the S&P 500 company has come up with a study. It's for 15 years, only 10.5% of the mutual fund managers outperform their benchmark or index. Okay, so if you can find that one person out there, 1 in 10, that does that, makes money after their fee, good. Now, what does this mean? So if you're talking to a manager, by the way, I have a fee calculator on my website. It takes 30 seconds to figure it out. Okay, so you put in a few numbers. The numbers you put in are how much you want to invest, or you have to invest, how much you're going to be paying fee, whether it's 1% or less or more. All right, just put that number in. how many years you're investing for. Generally 20, how many years, 5 years, 10, 20. Most people are 20 or 30 years. That's their horizon. And then what do you expect to earn? And most people are targeting a 7% return for their retirement assets over time. Okay. Now, if you can make more, great. In the last 10 years, we know that the S&P 500 is up about 15% a year for the last 10 years. That's not going to continue. Okay. For 100 years, the S&P 500 has gone up about 10.4% a year with dividends reinvested with no taxes, which is what you get in a retirement account, or you get a return without dividend, without being taxed, and with dividends reinvested. Okay, so over time, it's been 10% a year. Will it do that every year? No. The last 3 years, it's been up. Last year was up about almost 18, and the 2 years before that was up in the mid 20s. All right, but in 2022, it was down about 18%, and bonds were down too that same year. I wrote my book because I closed my firm after 25 years in 2020. And I asked folks in 2022, friends of mine, how much you paying your advisor? And a dozen people said, I have no idea. And not only didn't know how much they were paying, but they didn't know whether they were getting a return after the fee. Okay, which is the only thing that counts. Because if your advisor is just going to make a less than a market return after the fee, what do you need them for? To feel good about it? And I got to tell you, Vincent, people are. I posted something on LinkedIn today, and the title of it was, Can you handle the truth? Okay. And most people with investment advisors get very defensive. I was talking to a woman yesterday, and I said, Hi, how'd you do? Oh, I'm doing great. I think I was up about 18% last year. I said, that sounds good. That's a market return. That's about a market return last year. I said, was that after the fee to your advisor? Oh, no, she does a great job for me. She's been doing a great job for me. And I felt like saying, compared to what after the fee? Because most people do not ask. So the one question that your audience should ask an advisor, if they're using an advisor, is please give me a report with the rate of return for the last 1, 3, 5, 10, however many years you've been with them, rate of return of the stock of an index that replicates my asset mix. They may not have everything in stocks, they may have some in bonds and other assets, but a benchmark return, composed benchmark, in other words. What is that return? And then what is my return after your fee for that same period of time, for the 1, 3, 5 years? And I was in the institutional world. I had endowment funds and family offices, and these were sophisticated, demanding clients. And that's what every quarter I gave them that report. And for the recent quarter and the various trailing periods. And so they knew exactly what they were getting after their fees. And if they didn't do better after their fees, they didn't stay around as clients. Okay. And that's the way my business worked. I was a consultant to these endowment funds. I also had managed money. I also had a hedge fund of funds. I did a lot of research on investment managers. So I worked real hard to find those few managers that could outperform at their benchmarks after their fees. It's possible, but it's a full-time job. Okay. It was for me. And anyway, so they have to ask their manager, what did I get? What's my return after your fees compared to a market index? Simple question and a simple answer. You're going to get two numbers. You're going to get the number that they earned after the manager's fees, and you're going to get the number of the return on the benchmark. Two numbers. That's it. So you don't have to not to be complicated. Simple question.
So to put numbers into that as a simple example, let's say the market, and when we say the market, let's say the S&P 500 returned 15% in a year. Your portfolio, you're 22, so you're all in. So every nickel you have in your retirement account is in an S&P 500 fund. That S&P 500 fund returned 15.5%. So, hey, beat the market by 0.5%. But if you paid the advisor 1% to manage that, it really returned 14.5% against a market that returned 15%.
Yeah. Yeah. And that's why I have this calculator on my website, because people don't understand it. What happens is compound interest is a very powerful force of nature. It is. And what I tell people is everybody's got a superpower. They do. They have an investment superpower. What is that? What is that? What is this guy talking about? What I'm talking about is if you stay invested, okay, and the younger person has a huge advantage over the older person because they have time. Time is a big advantage. That's another superpower that they have, is they have time. Okay. And it's important. All right. But the point is, the thing is, most people don't get, they think it's only 1%, only 1%. 1% compounds over time. What happens is it's not just the 1% you're paying, but it's the earnings on that 1% of your portfolio that you're losing over time. So if you go do this fee calculation on my site, again, it takes 30 seconds. And you don't have to put your email in. You just go to my site, there's a fee calculator window, and you go in there and you just put it in and it's done. And then you see what it is. And if you can find that same kind of calculator on your wealth manager site, then that's great. I don't think they exist. And I built this calculator last year because they didn't exist. And that's the main point of my approach, is that you got to know what your expenses are. And I didn't make this up. Warren Buffett did 50 years ago. Okay. And so did John Bogle at Vanguard. So it's not my idea. It's just math. Anyway, so now we can get into what's the most important thing you can do when you invest is, you should know but we can get into that and I will just take your questions as we go, because I could go on forever.
And I could listen forever. Certified money nerd over here, enjoying every second of it. But I wanted to draw a line under something that you just laid out there. It's funny, when we talk about compound interest in investing, we usually talk about it in a positive sense. So if you start investing when you're 20 and you invest X amount for Y amount of time and you get Z return, the magical power of compound interest will make that grow significantly. That is the good magic of compound interest. The magical compound interest that you're talking about, I wouldn't say it's the bad, but it's the cautionary side, because you're almost talking about opportunity loss there.
That's exactly what you're talking about. All right. Now there's another, and I'll get into that in a little bit, but once again, I would encourage everybody to go and find a compound interest calculator on the internet. They're all over the place. And then you can put in how much you want to start with, whether it's $100 a month or $10 a month or whatever it is, or $1,000 or whatever it is, how much you want to start with, how much you're going to put in every month, how long you're going to put it in for, how much you expect to make. And if you're invested in the stock market, if you're 100% in the stock market, you could probably put a number that's closer to 8%. The stock market's been up 10, but let's just scale that back a bit, because we never want to get over our skis here. And so put in 8. By the way, 7% is going to double your money in 10 years. All right. But then by putting money in other words, you're dollar cost averaging. So you're buying stocks when the price goes up and when the price goes down. Okay. So you're buying more shares when the price goes down. So what is the stock market all about? It's basically, for almost no money at all, you can hire 500 of the best corporate managements in the world to manage your money for no charge. The S&P 500. Now, the stock market is going to value those efforts by those corporate managements at different levels at different points in time. But over time, because they invest for returns to their shareholders, it's a great benchmark it's a measurement of corporate management over time. And it has, again, I say literally for 100 years, it's been 10.4% a year. So it's not going to happen every year. And if you invested in March of 2000 at the top of the dot-com crash, you didn't make any money for 10 years. But after that, you did make money. But if you kept putting money in during that time, you did okay, because you were buying at lower and lower prices. What do we want? We all want a bargain, right? We want to buy at lower prices. But what happens with people is they get freaked out. And the other thing that happens, we'll talk about risk, because that's a super important part of this whole discussion. Most people worry about having too much risk. Now, my whole thing, and I have a risk calculator on my website, and it's based on a Nobel Prize winning theory. And yes, you have to put your email address in, but it comes up with a risk score. So here's a fact that the firm that I work with has come up with. Surveys, half the people under 30 are not aggressive investors, and half the people over 70 are aggressive investors. So to say somebody's aggressive doesn't mean anything, all right? Or conservative. What does that mean? It's a subjective term, okay? It could mean different things to different people, because your aggressive might be different from my aggressive. What does that mean in a portfolio sense? This risk calculator comes up with a score. It puts a score on it, okay? The S&P 500 is about a 72 risk at a scale of 0 to 99, okay? 72, all right? Now, I'll tell you a story here. I had a gentleman fill out that he's 65 years old. I filled it out. He had a risk score of 68. I thought that's pretty aggressive for a guy that's 65, but okay. And then I looked at his portfolio, I ran his portfolio through my system, which takes into account the past returns of his portfolio holdings, the constituents in his portfolio, the different funds he had in his portfolio. And over the prior 10 years, he had actually, and his risk score of that portfolio was 38. What does that mean? It means he had about half the risk that he really wanted. So what did that mean? It meant that he left in the prior 10 years, again, the S&P is up 15% a year for the last 10 years. He left about $1.5 million on the table on his portfolio that was at the time about $3 million. It could have been 4.5 million if he had invested it consistent with what he said his risk tolerance is. Okay, now if he had done it 10 years ago, his risk tolerance might have even been higher. But I'm saying that most people worry about having too much risk, but you also have to be concerned about having too little risk. It's not a problem if you're 22 years old, as you mentioned, but it is a problem if you're getting a little closer to when you're going to need the money.
Because
And
yeah, just about
I'm not
itself,
asking,
the time
but
that
look,
you
I'm
have left to
78.
invest,
Pardon me?
the time that you have to invest mitigates the risk. Because the risk, when it says 72% risk, is that 72% chance that you will lose money over X
It's not
amount of time?
It's not a probability score. It's a score that really is developed by this group that's relative to the market.
Oh, okay.
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 And what the way that works then is okay, so there's a questionnaire, and basically risk. People are 2.5 times. This study, this Nobel Prize winning study by Danny Kahneman is his name. He's no longer with us, but he published a book called Thinking Fast and Slow about 20 years ago. So it's a classic for investors. They should read that book. And just like anything else, if you make a decision based on emotion, you could regret it. Okay. And most of us know that when we're in a heightened emotional state, we can make mistakes. And the same thing with investing. You got to keep cool. And so, what this theory holds is that people are 2.5 times more concerned about losing money than gaining with their money. And that's how the wealth management industry exploits that phenomenon, that behavioral phenomenon, because people think if I go to this wealth manager, they can save me, they can protect me. Hey, the only person that's going to protect you is you, right? And because what's going to happen is you're going to get tested. And it's like everybody's got a plan, right? And Mike Tyson said, everybody's got a plan until they get punched in the mouth. You go into that ring, yeah, I got a fight plan figured out, and then it's, oh my God, that guy hits like a ton. And they freak out. No, that's not the way you win a fight. You win a fight by staying with your strategy, right? And so that's the point. You got to stay with a strategy and be resolute and confident that it was the right strategy to begin with.
Now, oddly enough, that whole idea of staying with your strategy, I've actually heard that as another justification for paying an advisor is, oh, the advisor's going to calm you down and keep you from doing a stupid thing when the market drops.
That's exactly what they do. And you know what? They're all going to tell you the same thing. All right. Here's like, how often have we had a bear market? Now, most of the people who are investing today have never seen a real bear market. I've seen a couple of 50 percenters. Okay. And COVID was a day at the beach. It was down like percent. It came back in 6 months. It was not that was 6 years ago now. But most people haven't even seen a bear market. And the investment advisor earns their money when they set a strategy. They determine how much risk the client can tolerate, and you never want to exceed. You don't want to. You want to know your risk tolerance before you exceed it. Right? How do you do that? This questionnaire helps you do that because what we do is if somebody fills it out, and I'll do this on a complimentary basis with your viewers, no problem. If they fill out that risk score and they say, okay, Andy, all right, I've got a 58 risk. What's that look like? And we can get into it. We can say, okay, here's what it means over the next 6 months. And it does a projection within 2 standard deviations. Oh my God, what does that mean? It means basically 2 standard deviations. 95% of the time, historical returns suggest that this is what your return will be over the next 6 months. Okay. And it does it in dollar terms. Okay. So your $100 is going to be worth 20, or it might be worth only 5 in 6 months. Can you live with that? I don't want it down to be 5. All right. So we have to reduce your risks. We have to reduce the risk exposure you have to those assets that could go down that much. And so there's a sliding scale that we could use. And so we do that. And so we really test their true risk tolerance. Okay. Now that doesn't mean that when the wheels come off, and they will, you're going to get tested. The market's going to go down. I don't know when, but it will. And things are going to look horrible the further it goes down. And the other mistake that people make is that the market goes down 10, 20%, 30%. Oh, I got to get out, I got to get out, I got to save what I have. When they do that, they're increasing the probability that they will not achieve their investment objective, because they're going to book the loss and they will not get back in right away. They won't get big. They want to think, oh yeah, I'll get in at the bottom. Think about it. You might remember this, but in March of 2009, after the great financial crisis, it was terrifying. Okay, the system almost collapsed. The market was down, started going down in October of 2007, and it went down about 50% till March 9th of 2009. So for a year and a half, it went down. Right? And it was like, and the news just kept getting worse and worse. The Lehman Brothers failed, and the banks were almost failing, and Warren Buffett had to bail out Goldman Sachs, and it was horrible. And I distinctly remember I had clients that were professional investors, hedge fund managers, venture capital, that sat on endowment committees. And they would say, hey, why do we, in February of 2009, why do we even own stocks? And I had to remind them that the reason you own stocks is not for 1, 2, or 3, or 5 years, or 10 years even. It's for, in this endowment fund, it's for perpetuity. And you know that corporate managements are incentive to make a return for shareholders, and the market will recognize that over time. And so basically, my job, like you're saying about investment managers, their job is to persuade the client to stay the course. All right. Their job initially is to set a course. That's the most important thing anybody can do. And then the next most important thing is to stay on the course, is to stay with your plan. And it's really hard to do, but again, do you want to pay an investment advisor every day? Because you're paying that fee, you're paying it every day. It accrues every day. It's not like a lawyer or an accountant. You pay them one time, you know what you pay them, you get your service, you get your result, and you want to come back, you come back on your own. But with an investment advisor, you're paying them every day, whether they do anything or not. So you should ask an advisor, okay, you're going to charge me this fee. What are you going to do for me? I'm going to help you set an investment policy. I'm going to write an investment policy statement. I'm going to do a retirement map for you, show you the projected returns over time. We'll do some planning about how much you want to put in, how much you're going to take out when you retire, et cetera. And that's what they'll do. And then what else? Then the next question you have to ask them is, okay, what is your structural advantage to add value to my money after your fee? I guarantee you, if you ask 100 of those managers, what's your structural advantage? They'll look at you like you're crazy.
At some point, you have just become more trouble than what you're worth. It's get out, bring the next guy in.
That's basically it, because they depend upon people being intimidated. And you don't have to be intimidated. And you look at the financial news, it's like these people are making predictions about what's going to happen to the market next month, the first quarter, the second quarter. I've been listening to the smartest people in the world do this for 50 years, and they never get it right. Okay. The best course is what Warren Buffett has said. You just stay invested, get invested, believe in America, basically. Now, having said that, international stocks have started to do really well in the last year. You probably noticed that.
Yep.
And why is that? One of the reasons is that since in the last year, the external value of the dollar is down about 10%, which means that benefits you if you own non-dollar denominated securities, okay, international equities, whether it's emerging market or developed markets, either way. And will that continue? I don't know. But the tide has shifted in favor of those international markets lately, where they were up quite a bit more than the S&P. They were up about twice as much as the S&P 500 last year. Yeah,
because for the longest, a really basic diversified portfolio is U.S. stock holdings, international stock holdings, and bonds. 2 of the 3 of those have really just sucked wind for what, the last decade. You're in national stocks and your bonds, and everything was off kilter. I'm not saying what you just said is good, bad, or otherwise, but it does provide some diversity of choice that we haven't had in a while.
I'll tell you that all right, there are strategic allocations or tactical. It's very difficult to allocate your assets tactically. In other words, I think emerging markets are really going to do terribly for the next 10 years, so I'm going to get out of them. Well, that would have been the right decision to make 10, 12 years ago. Okay. It was the wrong decision a year ago. Okay, but it's really hard to make this. So what do you do? A prudent investor will have some money diversified into that category: emerging markets, developed markets. There are other categories too we could talk about, but I think having that kind of broader diversification is prudent. Okay, you won't get the top return every year, but over time you'll get a competitive return. And one of the things that's super important is you will note that the manager, the wealth managers, I see a lot of advertisements on TV, and they're aspirational. They show people on the beach with their grandchildren and on a nice house somewhere, but nowhere do they say, "Here's what we charge and here's what we get for what we charge." They don't say that.
Don't worry about it. Just order another Mai Tai and get the Cabana boy to come over and clean up. Yeah.
Yeah, and then the thing is that people say, "Oh no, I can't do it myself. I can," but they don't understand what it costs to do that. And if they did understand, what you get, just go to my site. There's a calculator. You don't have to. It doesn't cost you anything. It doesn't cost you a nickel to do that. It costs you maybe 5 minutes of your life to figure it out. And but anyway, so I like to keep it simple, keep portfolio construction simple, but also to make sure people have the right amount of risk, not too much, not too little, the right amount over time. And what does that mean? And then so what do I do? First of all, you don't need to have an wealth manager or a guy like me at all. You can do it on your own. Okay, you can do it on your own. And my book talks about a strategy to do that. Here's how to assess the risk that you have if you want to invest like your money in stocks or bonds. Bonds are not a good place to be over time. They just have never been, and there won't be. It doesn't mean you shouldn't have some because it's a liquidity reserve. I will say this: Warren Buffett, in his 2012 letter to his shareholders, said he has instructed his trustees to put 90 when he passes to put 90% of his money into the S&P 500 and 10% into intermediate term treasury notes. That's what he did. And that
And I was just chuckling because that's not what you read on social media. That's not what you read in little clips. You read more, Warren Buffett just got out of the market. You need to get out of the market too. You hear garbage like that, not fact that you just stated.
that's a, fear sells, dude.
Yep.
Fear sells. You're in a movie theater and somebody yells fire. What's going to happen?
It's going to be a stampede.
Yeah. And fear sells. And that's the media does all day, every day, is they're selling you stuff that'll get clicks, basically. All
Exactly.
right. And fear sells, so that you see these breathless YouTube videos or other folks out there who are well meaning, and maybe they're right. They could be right. But I'll tell you this, that if you're bearish on the stock market, it's a bet that has a low probability of success. If you think you can time the stock market, I have a chart on that. I posted a chart on that on LinkedIn, I don't know, earlier this year. The stock market, all of the return in the S&P 500 over the last 60 plus years has occurred in less than 5% of the time. So if you've missed the 5% of the months that are the best months, and I could send you this chart, I'm happy to do that, but I can show it to you on the screen here for that matter. It's right here. But the reality is that this is the return on the stock market if you miss the best months here, and this is a return if you stayed invested. This is a return on treasury bills. Where's treasury bill return here? And it's a dramatic difference. It's a dramatic difference. And it doesn't take much because most of the returns come after the big declines. And you can't figure out when there's going to be. And most people miss the upswing. They don't catch the bottom anyway. So don't try to time the market. Stay invested. Don't be fearful. And most people get advice to don't be fearful. We worry about so many things that never happen. I think that's a fair statement to say.
Yeah, we worry about things that have a very low probability of happening. We also worry about things that we don't understand. The more we don't understand something, the more fearful we are of it. Some of that fear is instinctive and inbred and is actually healthy if you use it in the right way, if you don't let it overtake you. But the fear that just comes from lack of knowledge, that's the one that you have to tame. And it's somewhere between your knowledge and if you're going to entrust that knowledge to someone to lead you through this, then it needs to be someone who's charging a reasonable fee. You hit on earlier the one thing that always bugged me about the 1% assets under management. Again, that is 1% every month forever and ever. I'm in. If I have an allocation that generally I'm good with, and I'm just going to make relatively small adjustments a few times a year or once a year or whatever the frequency is, why am I paying you to manage it every month? The funds that I own, those guys do some trading every month. I think that's enough trading. So, in my opinion, where I do want to save my money personally is once I retire, I do need to understand the tax situation. I will enlist a CPA to help me figure that out.
Well,
But
yeah, I totally.
yeah, but I'm not going to be paying that CPA 1% every year
No,
forever and ever.
you don't pay your dentist 1% of your asset value every year, do you?
Exactly.
Why should you pay your money manager 1% of your asset value every day, or a percentage, 1/365th of it every day? Because they don't do anything. You should ask, what do you do every day for me?
Yeah. Yeah.
And I will tell you now, if they're active traders and they actually can make money doing that, which is almost impossible to find anybody that does that, and plus you incur tax liabilities. At the very least, you incur transaction costs and risk of missing the market. But anyway, what do you really do for me? What are you going to do for me? And the reality is, you're absolutely right. Why should you pay them all the time for telling you once every 2 or 3 years to stay the course?
That's a great way of putting it. And
No, it's like
yeah,
that's true.
yeah. The other thing that I just realized personally for myself, my personal 401k is through Fidelity. Only recently have I really dived in to understand the level of services and the level of fee structures that they have. So that's just one example. There are others out there. But if you really do your research, you'd be fascinated that the 1% fee people in my world, in my corporate world, are the ones who've been coming around for years, and they take you to lunch and there's a seminar and all that. That's the 1% guys. The guys who are charging more reasonable fees, I don't think necessarily they have the money to go and wine and dine people. You have to find them, but it's worth the effort.
Look. I first of all, Fidelity is a terrific firm. I use them myself. Okay, there are a lot of services they offer that are cost free,
Yep.
or if they cost anything, it's a very small fee,
Yeah.
very small for funds. They do have some, like every other mutual fund group, they do have some funds that outperform their benchmarks over time. And if you want to take a little chance with those, go ahead. But once again, I one of my goals when I work with people is to keep their expense ratio, again, that all in expenses of managing that particular portfolio, down below 0.1%, below that, and hopefully way below that. Okay. There are certain ETFs that charge fees that are a little higher, like emerging market ETF is a higher fee. But if you keep your fees low, you're ahead of the game. And then it's fun. My brother, who's one of the people I asked, I said, "Hey, Bob, do you know how much you pay your money manager?" He said, "I really don't know how much I pay her, but I really like going to the polo matches in Newport every summer." And I said, "Well, you should ask." He said, "Yeah, I really should cross-examine." He's a retired trial lawyer. "I really should cross-examine her on what the fee." I said, "You don't have to cross-examine her. Just ask her what she charges you and what your return is after her fees. That's all. It's a simple.
Yeah, yeah. Figure that out and then compare that to how much it would cost you to just take yourself to the polo match every year.
Exactly. Yeah, exactly. And so I'll tell you, it's the highest. It's one of the highest legal margin businesses there is. All right, think about it. Think about it. All right, if you get they're getting, and if you look at their public filings, their 10Qs with the SEC, these big like Morgan Stanley, the big companies, the big public companies, you look at what they're charging their asset managers. They charge about 1% on average. Now they scale it down, so if you have a bigger account, you pay a lower percentage, but that's very big. But they're over 0.9%. Call it 1%. And think about that. So they have, just do the math. They have on $1 million, that's $10,000. On 1% of a billion is $100 million. It's $10 million. It's like, and 2 billion is $20 million.
And their market is doing nothing but growing and growing as baby boomers retire and are more dependent on those 401ks forever. These guys are just standing here.
It's making it
Yeah,
in.
yeah, just setting the traps. Sure, let's go out to lunch. I get more of those things now than Yeah,
Yeah,
I
but
it I was never like an athlete or anything, but sometimes I think this is maybe as close as I'm gonna get to that feeling that a really high level athlete gets when a school is recruiting them or something, 'cause
oh, that,
they come out of the
I
woodwork.
I feel really bad for those guys. I happen to know a couple of NFL guys, and they've been retired, but they say the problem is that these guys make so much money so young, and most of them within a few years they're down to almost nothing because they just spend it like crazy. And that now they do have agents. Those agents charge them a ridiculous amount of money.
Yeah,
Talk about 1%. They're charging them 10, 20%. But the business itself of the money management business is very so that grows at the market rate, which over time is 10% a year. So check this out, right? What if we had a business where we got assets under management and we talk to people 2 or 3 times a year, maybe take them to lunch once or twice a year, and you get paid every day, and that the value of their money goes up. And let's see, so they start out with a million, and then it goes to 7 years later. It's 10 years later, or seven at 7%, it doubles. At 10%, it doubles in 7 years. So in 7 years, it's double. It's now 2 million. Are they doing more work for the $2 million account that started at a million than they were when it was $1 million? No, they're not. They're making the same decisions. It's just getting paid twice as much for
yeah. Not
it.
only that, but some of the conversations that I've had when you mentioned that fees are negotiable, I've talked to some of these outfits that have told me point blank, it's a 1% for the first 2 million or the first 3 million, but then after that we'll knock it down to 0.5%. They're actually making it a better deal for the wealthy than the whew, I saved enough to be able to retire crowd.
I think that it's a fair question to say, wait a minute, are you doing more work or half as much work for the people that have more money? What's the point here? To justify the fee. Again, how do you, and I'm just telling you right now, the fees, it's a legacy fee. It's an accident of history. They haven't changed. In our world, all right, we didn't have Amazon 30 years ago. We do today. Okay. We don't have to go to Kmart and Sears anymore, and we go to competitively priced places now, or we go to Amazon and we get a lot of information. We trust them, and we know what we're getting, and we know what we're paying, and we're saying. And so there's been a lot of advances that technology has delivered to us and continues to deliver to us. But it's delivered those advantages to the wealth management firms, but they haven't passed those cost savings on to the clients by lowering their fees, have they?
This is true.
Almost everywhere in the world, we see fees have come down. Fees on telephone expenses have come way down because technology has driven the cost down, and but not in the wealth management. So what I'm trying to disrupt a $300 billion a year business single handedly. All right, I'm trying to pull the curtain back on this business and just ask some simple questions to your wealth manager. Okay, and I guarantee you, even if hopefully you'll like the answers, but you'll better understand each other based upon those questions. I guarantee you that. And maybe you'll like the answers, and maybe they're good answers, and maybe they are adding value after their fees, and I hope they are. It's hard to do, but maybe they do it. But they do not have they don't have secret sauce, and they don't know any more than what's going to happen in the future than you and I do. They do not. They can say they do, but they don't.
Yeah.
I like to. They don't know any more than my dog who's standing right here next to me. I can't really see him, but he's right
I
here.
saw that. That's a pretty intelligent looking dog. He
Oh,
may be able to beat your average in five
get over there! Get over here! Get over here! Get over
That
here!
is a pretty intelligent looking animal. So,
He's a big dog.
what's his name?
His name is Enzo.
Okay, so Enzo, good time to buy Amazon or not?
He thinks he's happy with everybody. He's just a happy guy. The other thing, one of the things I say in my book, I say invest with confidence and peace of mind, but also I say invest with joy. And why do I say that? That sounds weird coming from an investment guy, right? A hard-nosed numbers guy. No, because think about this. If you've made a decision to save, which is a hard decision for most people to make, that's a reality. It's a time preference. How much do I spend and how much do I save? It's always weighing those two competing factors in your life. And it's a hard decision. But once you make that decision to save money, then you should be rejoice that you've done that. And also, the other cool thing about it is if you have decided to assume risk of the unknown, which is the stock market, you don't know what's going to happen. You hope it's going to keep going up over time. And let's say it does go up. How do you feel about that? Pretty darn good.
Yep.
It's like a challenge. It's almost like a game that you won a game, and it feels good to win a game.
Yeah.
So
Yeah.
when I say joy, I really mean that. It's almost like, and we get to benefit from the magic of compounding.
Yeah.
It's just so cool. It's, you know,
That
I've said it a
yeah,
few times now, and I know I repeat myself, and I apologize,
yeah.
folks, but anyway.
That's a great way of looking at it, because look at the alternative. Where's the joy in the alternative? If you are too afraid to take that chance, then in all probability, you're going to find yourself financially struggling to one extent or another for the rest of your life, outside of one of your kids becoming a professional athlete or something. You're going to be struggling for the rest of your life. So you have 0% chance, in a sense, in a material sense. That's not in anything else. That's not everything, but a very thin percent chance of material fulfillment. If nothing else, living a life where you don't have to worry about money, because sometimes that's the greatest thing about having money is I don't have to worry about money.
Yeah, that's true. It's really true. But the other side is that wealthy people are not necessarily happy people. Okay. Now, I sent you a graph, okay, before, and basically you don't have, nobody has to see what the graph looks like. All I could tell you the numbers. If you had, I went back 50 years, okay, and $100 50 years ago today would buy $16.60 worth of goods because of inflation. $100 invested in the S&P 500 60 years ago would be worth almost $29,000. That's $100 50 years ago. How many of us now? I've been around for a long time, but your audience can think about it in terms of 20, 30, 40 plus years. Okay. And I don't see any reason why those numbers are going to change all that much. Now, there was a period in that 50 years, which was from 2000 until almost 2010 or 2009, really mid 2009, where you didn't really make any money, okay, in the stock market. But if you stayed invested, you did. You made a lot of money. But the point is, inflation is a killer,
Yep.
and and that's the only reason you take any risk is so you can stay. Now, the other side of the joy part of it, or the lack of joy, or the fear, or the despair, is you get to a point where you're not able to earn money anymore,
Yep.
or not very much, and you got to have something to fall back on. And that's this whole thing about retire. Now, I do not ever want to retire. Okay, my father's 101 years old, and
Wow.
he's still, yeah. And but I closed my firm 6 years ago, and I got bored. I tried retirement for a couple of years. I got bored. And I wrote a book, and then I started this new firm with a different model, a fixed fee. I charge not very much money to set you up, to give you a policy statement, to give you a retirement projection and map, and a small ongoing fee if you want it. Okay, so you could always have access. Like if you have questions, you could just ring in and say, "Hey, what do you think, Andy? What's going on here? Take a look at my portfolio. Are we on track? Should I make
Yep.
changes?" And I almost guarantee you that there's really no reason to make changes once you set it up. You don't really have to. You
Yeah,
don't have to.
exactly. You're doing business the way you want to do it, because whether or not you're technically retired is one thing, but you're, as they say, work optional. So when you decided to go back to work, you could do it completely on your terms. What you're doing is not the way that people build wealth in the financial services industry. It's just not. But somebody like you who's got that behind them, you have the freedom to tell the truth, the
Right.
complete unvarnished truth.
Right.
And I just want to thank you for deciding not to just kick back on the beach somewhere and drink Mai Tais, because that was an option on the table. But appreciate you continuing to spread your wisdom. In our key links, we will have a link to ParrilloInvestors.com. That's where our listeners can find your resources. They can find your book. They can even arrange some time to speak with you one on one. Other than that, are you on any social media?
I'm in LinkedIn. I have an account on Facebook. I don't use it for business.
Okay, okay,
And,
gotcha.
but if you want to see pictures of my dog or whatever I do, and that you can see them on LinkedIn or on Facebook. But I post on LinkedIn all the time with
Okay,
investors.
we'll be sure to link up your LinkedIn. And I actually have one other question, then I'm going to let you go because we've held you longer than we should have. The Super Bowl is just a few days behind us. And this may be a random draw, but has anybody ever told you you look like Pete Carroll? That has been going through my mind this entire time that we're talking.
First of all, I moved down from Boston a year and a half ago. Okay.
Okay.
So I'm a Patriots fan,
Okay.
number one.
Okay. Gotcha.
But I've had quite a few people ask me that.
Okay. Okay.
Yeah.
Okay.
Up there that, hey, yeah. But I think he was great. I'm sorry what happened to him at the Raiders, but hey, too bad. He's a good guy. But
Well,
that's a tough job, man. That's got to be the hardest job in the world to be an NFL coach.
oh, yeah. He'll head to the broadcast booth. He's a personality guy. He's an energy guy. He will learn to love that lifestyle along with Brady and the rest of them that hung it up.
Actually, the Patriots, I lived in a building, and a lot of the Patriots had lived in that building, and they put a weight room in there, which I actually used because that, but yeah, so no, that, look, I have my hats off to them and all the Seahawks. Of course, they're great. They were incredible. They blew them away. I'm sorry to see it. They did their best, but hey, it's a game. And they look, as long as they're having fun, but they got some real talent and they're going to come along.
Hey, I'm a guy in Atlanta who is a New Orleans Saints fan, so I can just say there's always next year.
Yeah, I get it. Yeah, I get it. Yeah, of course.
All
Of
right.
course. Yeah, yeah, it's cool. It's a game. I got to enjoy it.
Yeah, yeah,
Yeah, and look, it's a game, but they get paid millions of dollars to play that game.
they do. They do.
And but the other thing is, it's a dangerous game.
Yeah, yeah. Yeah,
Yeah,
and that whole thing that you mentioned earlier of the tremendous wealth in a short period of time, that's the thing that makes it so important because their life in the long run could have a lot of medical issues to take care of. So hopefully there are people speaking into them in those spaces because you want to talk about piranhas. I'm sure those guys can't turn around without some piranha with an investment idea for them.
yeah,
So,
yeah.
Andrew, really
Anyway,
appreciated
thank
your time. Thanks for being on CFO at Home today.
I appreciate you. I really do. You asked some great questions, and I could go on forever with you.
Hey, two money nerds chopping it up. So could I.